Thank you everyone for coming today to this lunch for the Global Value Fund. With you today from Global Value Fund are my two CIOs, Mark Ambrose and Miles Staude. Mark is over from London and Miles is over from Sydney. And I am Emma Davidson, the CEO of Staude Capital, the manager. Today, in our time with you, we were going to cover four main topics. A quick update on GVF, what's been going on, how have we been going, the big picture, few words on that, not too many, because I'm sure you're all bored to death of the big picture. And then passive, active, private. We're going to talk about two tectonic changes that we think are taking place in the markets and that will continue to take place over the next couple of decades. And then if we have some time, maybe one or two case studies to go through. Okay, so let's get cracking. Many of you will know the Global Value Fund, but for those that are new, allow me to spend a few minutes just talking about who we are and what we do and how we've done over the last 11 years. The first thing that GVF looks for when making an investment is a discount. So that's our number one priority. Trading at a discount is when the share price of a company is worth less than the underlying assets that that company owns. Here in Australia, there are 100 or so such companies that have this ability to trade at a discount. Overseas, there are thousands of these companies, and the total size of the market that we look at is about $600 billion US. And these companies can be literally they can hold assets, anything from equities to bonds to real estate to hedge funds, private equity, you name it. There is companies out there that own all types of assets. So we go in to invest, and we look for one, the discount, and two, we look to diversify our underlying asset holding as much as possible. And so far, with 11 years doing this now, we're very proud to say that we haven't had a single down year in the 11 years that we've been going. There are only 7 other products in the Australian universe that can claim the same. The company... Oh, thank you. Thanks. I don't know why I'm saying thanks. Well done. Annualized returns after all fees and expenses have been 11% per annum since our IPO, and on a risk-adjusted basis, there is very little that has done better than GVF. Now that's a very big statement and a bit bold to say, but allow me a few minutes just to qualify that statement. I think most people will agree over the last 11 years that probably one of the best performing asset classes has been the equity markets. They're well above the long running averages, and if you look at the equity markets, here on the screen I've got the Australian ASX 200, I've got the S&P 500, and I've got the MSCI, which is the top 2,500 companies in the world. So I'm showing you Australia, the US, global, and I'm showing you those annualized returns for each. Australia has given us 9% per annum over the last 11 years. US shares 16% per annum over the last 11 years, and global shares have given us that 13%. These are well above the long-running averages for these indices. Now, we all know that only part of the equation is the returns that we get. The other, equally important, is the risk we took to get those returns. And the most common metric used in markets is the volatility of an index or an underlying or an investment. The volatility simply measures how risky, how much something goes up and down. And you can see here the volatilities for the ASX, the US, and globally. The highest volatility came from Australia with the lowest return, which is not usually the formula that you're looking for. To quantify this and to provide a quick reference number, the market refers to a Sharpe ratio. And the Sharpe ratio is simply the annualized return divided by the risk-free rate and the volatility to give you a quick reference number. The reference number basically tells you the quality of the returns that you've received. The higher the number, the higher the quality of returns. What you can see here is that the US have given us as investors the highest quality of returns. for the amount of risk that you've taken, you've received the best return for that. Then global shares, and lagging quite a bit is Australian shares. So we've taken a lot of volatility for comparatively not enough returns. Over the same period, GVF has run with annualized returns of 11%. The volatility has been 7.6%. And again, if you focus on that Sharpe ratio, noting the higher the number, the higher the quality of returns, you can see that GVF really has kind of done a really great job for investors. Now, a lot of people like to argue how to measure risk rather than argue about which ratio is best to use. I've also shown the Sortino ratio up here on the screen, and I've also run some correlation numbers for anyone who's interested in correlation and R-squared. But hopefully what you'll see from all the numbers is that GVF has really outperformed just across every metric that we've been going. And we're just very proud of that, and we're very happy that we've been able to pay that all back to you guys as investors. Just in terms of the share price, because let's be honest, that's the thing that matters to everybody. We launched at $1 for 11 years ago. That dollar is worth $1.35 today, and we've paid out 90 cents on the dollar that we had. So it's hopefully been a good experience for everybody. At the back of this, and I'll leave this, I'll go to that at the end, but at the back there is a picture that we have of the share price returns that you can refer to. But for now, I might hand over to you, Miles, just talk about the big picture. I wonder who we're going to talk about.
Thanks, Sam. Well, leave it back on the one before.
Yeah.
How do I? No, wrong way. I'm just going to digress quickly. One of my big pet peeves in the markets, this is not what I'm supposed to be talking about, is risk. So I think we have this huge focus when we talk about investing on returns. So there's two parts to the investing equation. There's returns and there's risk. And if we're all honest with ourselves, when we go to the pub at the end of the week on a Friday and talk about our investment portfolio, there's a natural inclination to talk about the ones that have done well and to talk about how much money you've made. But there's very little discussion about risk. How much risk did you take to make that investment return? There's lots of different ways of looking at risk. I was just going to simplify this for everyone. Basically, the higher these numbers, the better, and the lower these numbers, the better. So you want your Sharpe ratio, your Sortino ratio is really, really high. You want your correlation figures really low, lets you build a better, more diversified portfolio. And risk is something that is a very kind of esoteric concept that is qualitative and quantitative, and the team and I spend a lot of time worrying about that. The easiest way, I guess, to measure it for us is that we haven't had a down year in 11 years. It means we'll never promise that that's always going to be the case, but against the backdrop where markets have been incredibly strong for a very long period of time now, it's very easy to get seduced into not worrying about risk. And I make the joke with the team all the time, you can jump out of a plane 99 times out of 100 without a backup parachute, and you'll be fine. Doesn't mean you did the right thing. And at some point, not having that backup parachute really comes home to bite. To talk about what I'm supposed to talk about now, which is the big picture, I won't dwell on this too long. Obviously, Mark and I follow this stuff intimately, so if you want to ask questions or there's anything that particularly interests you, please don't be shy. But just to run us all through, to get us, I guess, all onto the same page of at least how we're thinking about life. Like most of you, I'm sure, I'm pretty fed up with reading about Trump. That's not a political statement. I'm just exhausted with the amount of Trump information I have to absorb. Unfortunately, that's not about to change anytime soon. The US is by far the largest economy in the world and the biggest, most important geopolitical power. And whether you like it or not, depending on what side of the political aisle you're on, he came in with a pretty strong mandate to shake things up, and that's what he's doing. Since he's come into office, and it's a little unusual, actually, as someone who's watched the markets for a while, since he's come into office, Trump's policies have really been the only thing that have mattered in terms of financial markets, which is normally you're expecting interest rates to move markets and GDP growth and unemployment. Really, it's what's coming out of his tweets that's moving markets on a day-to-day basis. And markets have really been through the ringer in trying to keep up with him and trying to price in what a lot of his new policies means. Just to quickly summarise the journey we've been on, so everyone, I guess, is at the same point. Coming into office, he had four kind of vague policy objectives. That was cut taxes, cut regulation, cut illegal immigration, and to use tariffs to rebalance world trade. I think it's fair to say in the run-up to the election and even straight after the election, most people in the business world and certainly in the markets expected Trump to be very pro-business and pro-growth, and markets rallied on his election win on the view that he would focus mainly on tax cuts and cutting regulation. He's since come in and kind of pulled the rug out from everyone, focusing on trade and tariffs, and his announcement has been much more aggressive than I think anyone really expected. And markets have had to go through a really painful repricing of what the future holds. In trying to understand on what's going on here, and this is not me sort of having a political view, I think it's just a factual statement, what Trump is doing with tariffs and trade policy has got nothing to do with economics. This is all politics. This is Trump throwing red meat to his political base. This is not an exercise in economic policy. As an exercise in economic policy, and I can say this as I'm an economist, they make no sense. They will make the US poorer over time if he follows through on them. That's obviously the US's choice if it wants to do that. But that's also why we had that nasty correction in March and April. So markets do not care about politics. They just care about economic reality. And markets sold off heavily, as they should have, in the face of this new news that came out. Since the market sell-off, markets, I'm sure you have seen, have rebounded incredibly quickly and very strongly. And that is basically on the back of Trump rowing back on his initial positions. He's paused some of these tariffs, and he's selectively rowing back on some of his more extreme positions on trade. And markets have subsequently had quite a big rebound. I think the optimistic, or I guess hopeful reading of that is that there are some guardrails on his actions. While he wants to remake the American economy, he probably doesn't want to be the president that's known for causing a nasty recession. So it seems that financial markets, and particularly the Treasury market, are able to impose some level of financial discipline or economic discipline on what Trump wants to do. So if you're sort of a centrist type of person and hoping for a calm ride through life, I think we can all thank the US Treasury market for keeping some of Trump's instinct in check. That's all interesting, and that's really how we've gotten over the last 6 months, that where we are today. We had a big correction, a sharp bounce back. All very interesting. As always with markets, we need to be looking forward, not backwards. So just to run through what I think is going to increasingly become the front page news story for the next few months and the rest of this year, is it's going to be the Republican, again, this is all politics, unfortunately. It's not unemployment, it's not GDP growth, it's not productivity. It's going to be American politics, sadly. And it's going to be the Republican Party's efforts to pass a big tax cut bill. So far, since Trump's come into office, everything he's done has been by executive order. Now, most of the serious business of government is actually done by legislation. That's the way it's supposed to be done. And certainly for big, important things like tax and spending policies, it has to be done through legislation. In the US, that means you have to pass a bill through the lower house, the House of Representatives, and the Senate, and then it has to be signed into law by the US president. And the problem that the Republicans face is in the House of Representatives, their lower house of parliament. They hold 220 seats. They need 217 to pass a bill. And looming over all of this is what all the sort of scheming and political manoeuvring is leading up to, is the US midterm election. So in November of next year, the entire lower house is up for re-election, so a bit over a year away. The Republicans only have a very slim majority now, and traditionally the incumbent party does very badly in the midterms. That's kind of the political consensus. Added to that, the Republican Party and Trump have been sinking in the polls since he's come out with some of his more kind of controversial policies. So for what it's worth, the bookmakers put the probability of the Democrats winning the House in next year at over 80%, so very high probability. And what that all boils down to now is essentially the Republican Party has one shot at getting through a big tax cut package through Congress. I think we're going to increasingly see this as the front page news story, just like for the last 6 months. Every day it's been tariffs are on, markets are down, tariffs are off, markets are up. I think we're going to see that as the conservative part of the party and the moderate part of the party battle it out to try and get consensus. I obviously don't know how it's going to pan out, but I think the easy reading will be, if they can get a package passed, it will obviously be supportive for the share market. If they can't, then I think one of the important legs for the market rally gets knocked away. And I don't think we should be too blasé and just assume this will happen. Just because they control all three branches of government does not at all mean getting a tax package through the Senate and through the Congress is a fait accompli. The analogy I think is really interesting, and if you all rewind back your memory, 2016, the news story that just dominated the headlines, especially in conservative circles, was repealing Obamacare. Republican rank and file hated Obamacare, were determined to see that law overturned. They controlled all three branches of the government. They descended into bitter infighting all the way to the end, and they weren't able to pass that. They weren't able to repeal it in the end. So I think that's an interesting analogy for tax cuts. The US is in a dreadful fiscal situation. Cutting taxes is perhaps not the most sensible thing to do. So finding a path through the different factions in the Republican Party is going to be interesting. And more importantly, I don't know how it's going to go. I don't pretend I know how it's going to go, but I think it's going to be the front page news story we're all going to have to absorb for the second half of this year. And I'll maybe just finish off in the big picture here. Can answer questions obviously later, but by adding or repeating the qualification, we, doing what we do, we don't at all pretend we're able to call what markets do next. And I'm always a bit skeptical of fund managers or market forecasters that say they have some magical crystal ball. As always, Mark and I and the team are trying to build an all-weather portfolio at GVF that we think very hard about risk and we think very hard about delivering an investment return in most market conditions that might come up, and that's all we're setting out to do. We follow the big picture religiously because we're trying to manage risk, and we're obviously at the coalface every day with markets, but we stick to a formula that Emma set out at the beginning, finding discounted asset plays around the world, buying dollars for a lot less than $1, and working really hard to unlock that value for our investors. And in that process, trying to build that all-weather portfolio. And as a segue, I guess, into what we're going to talk about now, we're going to talk about passive, active
and private. Yes. Okay. So we always try to come out and do something a little bit interesting, maybe. You can be the judges of whether it is interesting. If it's not, you can boo us at the end. The third agenda item is these two tectonic changes that we think have been taking place for a while, and which maybe, well, I definitely took me by surprise, I'll be honest. 2 years ago, I didn't realize how much this change had taken on. The first is the incredible growth of the private markets and the disappearance of public markets. And the second, the exponential growth of the passive industry. As we see it, these two forces have only just begun. And as we look 10, 20 years into the future, we believe the investing world is going to look quite different to the one we know and understand today. In our time now, Miles, Mark and I are going to try to kind of just give you a little bit of a sense of what's going on. I will talk a little bit about passive investing. Miles is going to talk a little bit about private. Mark is going to talk a little bit about how that world has changed so dramatically and what it might look like in the future. Okay, starting off with passive investing. Well, passive investing, as we all know, started with the efficient market hypothesis, an academic idea that was born in the 1960s. The hypothesis stated that asset prices instantly reflect all the available information that is out there about a company. And so consistently outperforming the stock market is virtually impossible. Historically, the way financial markets have worked is that there's been teams of hardworking analysts examining company accounts, studying industry trends. There have been armies of economists crunching data, building models, and all of these people and all of that work has gone into working out the fair value of assets, whether it's the value of General Electric or indeed the Australian dollars in the international markets. All of these people have come together to create and value these companies. Now, the efficient market hypothesis says that given there are all these people out there analyzing all the data and all the information is already in the price, when you turn up to buy a stock, everything you could want to know is already there. Now, in 1975, Vanguard introduced the first mutual fund designed to track the S&P 500. Bogle took the idea of the efficient market hypothesis one step further, and he said, well, if everybody is doing all of this work and everybody is paying for all of this work, why would we bother doing that? Let's just piggyback off everybody else's work for free and provide a passive strategy, an index tracker. And that essentially was the birth of the low-cost index tracker that we all love and know today. In hindsight, active fund managers didn't really stand a chance, to be honest. They were footing the bill for all the analysis, all the data crunching, and the passive indices would simply track those. The results, remarkably, the S&P started a scorecard in 2002. The scorecard was designed to compare how are active fund managers doing versus the indices? Unsurprisingly, they've been going now for 23 years, and the picture is always the same across whichever country you look at. These two pictures here, the United States, because it makes up 65% of global financial markets now, and Australia, because it's relevant to most of us in the room. The light blue shows you all the active fund managers who've done worse than the S&P. The dark shows you who's done better. Same in Australia, right? Now, and this is universal across the board. The summary of which, 23 years of data later, the summary is just buy passive, because even if you do manage to choose the right manager, the likelihood that they will be consistent is very low. Globally, the passive industry is now bigger than the active funds management industry. And in the US, it is set to hit parity this year. So the dark blue here is active funds management. The gray is passive. This is 2011, just to give you a sense. And you can see the exponential growth that we've seen in passive, and the fact that this year in the US, the largest financial market in the world, we are going to hit parity where we'll have just as many active managers as passive managers. So that's a bit about passive, but let's talk about what the consequence of that growth has been.
Okay, thank you. So I got the clicker here? Yep.
Yeah, the clicker's there.
Thanks, Emma. So as Emma was setting out, there's been two, as we see it, over the last 20 years, two kind of tectonic forces going on in financial markets, and the change every year doesn't seem that big, but over long periods of time, market structures have actually changed quite a lot. One of them has been this incredible growth of passive investing, which Emma talks about, which has been a tremendous success as an industry. But it's important to note that how passive investing works and why it's been so successful, it's basically a free rider. So it doesn't pay for any of the work of the analysis that goes into pricing stocks. It just freeloads off active managers in the market. The other big growth that's been going on in markets today that I'm going to start talking about, Mark will finish talking about, has been the incredible growth of private capital and the private equity industry. And just to sort of frame what's going on here so we all have a bit of an understanding, 20, 30 years ago, the only place you could go to raise large amounts of capital to fund a business was public stock exchanges. So if you had a listing on the ASX or the New York Stock Exchange, it gave you access to the largest and most sophisticated pools of investment capital you could find. If you wanted to run a large, proper business, public markets were really the only place you could go. Fast forward to today, and that's no longer the case at all. Today, the private equity industry is increasingly replacing public markets in terms of supplying capital to companies. You can see on this chart here, this is the number of companies listed on the New York Stock Exchange, so the biggest, most important stock exchange in the world, over 30 years. And you can see the number of companies, I don't know if you can see it, Jerry, but has halved over 30 years, gone from 8,000 to just over 4,000. At the same time, the number of companies owned by private equity firms has gone from 2,000 to 11,000, so a five-fold increase. And the reasons for this big shift away from public to private, they're not that hard to understand. Regulation, litigation, relentless kind of public scrutiny, and of course the fact that any innovation you bring to a public market as an active manager is going to get copied for free by the passive investment industry. It all means raising money from public markets has gotten a lot less appealing, especially when there's an alternative out there. Worse, not only are existing public companies being taken private, I think the more insidious thing that's going on is that you're getting less and less new companies coming to market, replacing the old companies that naturally come and go through time. The typical life cycle of a new company now with a clever new idea or the new widget they want to make is that instead of coming to the ASX for its growth capital, it'll go to a venture capital firm. And if the idea works, they'll sell it from a venture capital firm to the private equity industry, and then the private equity businesses will take it and extract all of the exciting growth out of that business over its life cycle. And the only time these companies ever really make it to public markets these days, sadly, is when private equity doesn't want it anymore, when it needs someone to sell it to. And we're increasingly seeing less and less companies list and less growth companies come to market. It's a real hollowing out of the public market space. You can see on this slide here, this is the total number of companies in the United States with revenues of more than $100 million, so big proper businesses. You can see that less than 15% of them today are in public market hands. So Public markets used to be sort of this dynamic gateway between investors and companies seeking growth capital. Today, sadly, increasingly, it's becoming, you know, the Betamax in a world of VHS. It's becoming very much an old-fashioned thing. Now, why this matters to the passive investment industry is passive investing really relies on two kind of academic pillars. The first is that efficient market hypothesis Emma was talking about. There's some pretty big holes in that, but I'll leave that alone for now. The other one is this idea that as a passive investor, what you want to be doing is creating a portfolio that replicates the market return, because the market return is the best return you can hope to get over time after accounting for risk. Now, what the market return is a bit of an academic concept, but what it means in practice, and I think this concept's really important to sort of focus on. What it means in practice is you want to own a cross-section of the economy as a whole. So in Australia, what that means is if Commonwealth Bank is the biggest company in the Australian economy, and it's 11% of the market here, you put 11% of your wealth in the Commonwealth Bank. And if BHP is the second biggest company here and has 9% of the market, you put 9% of your wealth into BHP, and so on. You create a portfolio that matches a broadly diversified cross-section of the economy. The problem with that thesis and that theory, of course, is this pie chart here. It's increasingly becoming the case that the public sector indices that passive investors follow are becoming less and less relevant. As a passive investor today, you do not own a widely diversified cross-section of the economy as a whole. You basically own the companies that private equity don't want to hold anymore. In the US, you know, just to sort of frame that as a real world, how do we deal with this and what does it mean for investors? In the US, a third of the S&P 500 index is made up of 7 high-growth, high-risk technology stocks. Now, there shouldn't be a financial advisor anywhere that says putting a third of your money into a group of high-risk, high-reward stocks is appropriate for all investors at all points in their life cycle. Here in Australia, the problem's even more stark. Half of the ASX 200 index is a couple of mining stocks and our banking stocks. That is hardly a broadly diversified opportunity set of exciting and new companies. And Emma's data from earlier highlighted the ASX has really exhibited a lot of risk for not a lot of return over the last decade. Mark's going to sort of continue on this theme, show why we don't think this theme that we've seen of massive growth of private equity and crowding out of public markets is going to slow down anytime soon. But I guess just to flow back to the big picture and to sort of talk about why we think these two issues are intertwined, I think what we're increasingly seeing is that the passive investment industry has been so successful, it's really forcing active managers out of the public space. So when Emma shows slides like she did before, it's absolutely true. Passive investors do a much better job in public markets, but the other side of that is you're seeing active managers increasingly moving out of public markets to run actively managed funds. There's just no incentive for them to do it anymore. You're much better off keeping your company private if you can find the capital, and you don't have to worry about passive investors freeloading off your IP.
Marky Mark.
And thanks, Miles. So as Miles touched on, one of the consequences of the tremendous growth of private investment capital has been a hollowing out of public listed markets, both in terms of new growth companies that just don't decide to list in the first place, or private equity firms that have taken out the existing companies that are already listed. As a potential investor today, this chart here shows the opportunity sets available to both public market investors and private market investors. You can see here on the left, this is an index of investable listed equities globally. There are just under 9,000 companies. Compare that to the bar on the right, which is the number of private companies globally, which is 215,000. So you've got an opportunity set 20 times larger, if not more, investing privately. Perhaps though a more interesting chart is this following one. This shows that despite the phenomenal growth of private equity over recent years, that was off a low base, and even today, private equity is only 12% as large as the listed markets. So it's hard not to conclude that this dynamic is going to continue. If you're a company today that needed capital, public markets are increasingly becoming your second choice. Your investor base are unengaged and passive. You've got the regulatory burden and the listing costs, which only grow each year. You contrast that with raising money privately, where you've got more like partners who understand your business model intimately, who let you get on with executing that business plan without focusing on quarterly earnings. You've got none of the public glare, and none of the, or far fewer investor litigation risks. Just adding to this tailwind for the private space, this shows the returns of private markets over several different periods compared to a public market equivalent. You can see that there's a consistent and considerable outperformance versus... Private, by the way, if people can't read it at the back there, it's quite small. The private returns here are in the blue. The grey ones are the public market equivalents. You can see here that over 5, 10, 15 and 20-year time horizons, private markets have outperformed public markets considerably. The exception there is the 3-year interval, and it's worth just thinking about why that has been. As we all know, over recent years, the Magnificent Seven have driven a lot of the returns of listed markets. So a very, very small group of fast-growing technology companies that have produced phenomenal returns off the back of AI and all the excitement around that. And you can say that, you could say that people have been very, very fortunate to have exposure to those companies over the last few years, and that they've been listed in the first place. Companies like Amazon, Google, Nvidia, listed over 20 years ago. If they needed capital today, chances are they wouldn't use the public markets to get that. And just to highlight this, these are the current crop of high growth technology companies that everybody's getting excited about today. So these are the largest private companies. You've got companies like SpaceX, controlled by Elon Musk, which is revolutionizing space travel and via Starlink satellite comms. You've got ByteDance, which is the owner of TikTok, the social media platform. That's valued at over $300 billion today. You've got OpenAI, the company behind ChatGPT, valued again at $300 billion. Stripe, which is revolutionizing online payments, valued at $85 billion. And Databricks, they're valued at $62 billion. So you've got over $1 trillion there of value, all of which has been created outside of the public space. Fact is, if your Facebooks and Googles today were launching, they just wouldn't even come to the public markets. And if they did, it would only be after private equity had taken out most of the growth from them and they were looking for an exit. I didn't want to press the forward.
Thanks for that.
It is just worth saying we're not here selling a private equity fund. We're just talking about a big change that's come about.
Along with passive, how markets have changed and how we think this will keep going. And really just to bring this back to GVF, just to talk about our own fund towards the end there. So we're very aware of these changes that are going on. And I guess unlike most funds, we're not constrained to tracking an index. We're not beholden to ignoring this opportunity set. And we're acutely aware of the much wider range of opportunities that are out there in the private space, and that helps both in terms of diversification, so driving down risk, and also just in the opportunity set. There are so many more opportunities out there in the private realm. Given we've only had a short time to kind of click on this very big theme today, I'll just remind one point that we didn't touch on, which is what's been happening in the private capital space with private equity taking companies, public companies private, has also been happening in the credit space. So today, large amounts of the credit world, debt world, that used to be publicly traded, is moving into the world of private credit. In terms of GVF, we've known about these themes for a long time. We invest into all of these types of opportunities. We do it through listed wrappers we find around the world. We actually have ownership of 4 of the top 5 of those companies in the GVF portfolio today. When we think about private markets, we know and understand them very well. They're parts of the market we've been investing in for a decade at GVF, and in my previous firm a decade before that. And we find ways to invest into them, always at a discount. We're not buying them at par, and we're generally buying them through listed wrappers. So we're not stuck in these vehicles that normally, if you want to invest in a company like SpaceX or OpenAI, you're investing in a private fund, you're locked up for 7 years. GVS finds kind of interesting opportunities to invest into these securities at discounts where we can buy and sell out of them. And importantly, at big discounts often where we can use our skill set to unlock the value. As you can see, private markets in terms of private equity and private debt have made up 20 to 30% of the GVF portfolio through time. It's not the most part of what we do, it's certainly not the most important part of what we do, but it is a meaningful thing that we add to the portfolio and we think an important differentiator. And I guess something to remind, there are these big themes going on in markets today, and it's increasingly becoming important not to get left behind in terms of what's out there.
I think for me, one of the things I liked about that slide in particular was when we talk about diversification, we truly are diversified, not just across the public markets, but also the private markets. So the huge tailwinds that we've seen there in the private equity space are not something that you're missing out on, because GVF does have that allocation in the portfolio and has done since IPO. Yeah. So chuffed with that. Please start eating.
Yeah, please,
I don't want
guys,
you guys to stare at the food. Please start eating.
Start. While you start, I'll just keep saying a few words. So we've done lots of, we'll do a case study now. Mark will get up and talk about one of our investments. In the past, we've done loads of case studies on private equity. So if you've come and seen us before, you have seen us talk about some of the opportunities we find in the private equity space. Perhaps not the most cleverest idea, but having spoken about private equity for most of this presentation, we now have an example that's not private equity, but still a really interesting trade that we've just gotten out of.
So this is a closed-end fund listed in. This is a closed-end fund listed in Hong Kong, and it's very, very simple. Owns Chinese equities. It's small, illiquid, generally retail-owned, and it's been a fantastic trading position for GVF. And in fact, for any of you guys who have held GVF since the IPO, this was the first trade to go in the portfolio, and up until March this year, we've held it virtually continuously for that whole period. So you owe a lot to this investment. It's also one we were never allowed to talk about. We were sworn to secrecy over it. Miles would have kicked off if we ever mentioned this. So this is our one chance to talk about this. And just generally, we don't tend to talk about trading opportunities, but just because we want GVF to just continue to take advantage of them over time. So as I say, this was this is a very sort of simple fund. It owns Chinese equities, trading on a really, really big discount. And what made this particularly interesting is it had a policy whereby if the shares traded at a discount of 20% to asset backing for a period of 3 months or more, they would tender for the shares, tender for 20% of the shares at NTA. So this created a really interesting opportunity for us if you could buy it at wider than a 20% discount. Firstly, the policy there was going to stop the discount ever going too much wider than 20%. But also, if it remained wider than 20%, you had this opportunity to exit part of your investment every time that they tendered. And if you think about it, if it's trading on a 20% discount, you've got a 25% uplift to NTA. Over the 10 to 11 year period that we held this investment, they announced a tender 10 times. As shown here on the right, these are the solid blue diamonds here. Each time, on average, we exited 40% of our position at asset backing. And the reason for that is, as I mentioned before, this was retail owned. So most people are not going to open the letter. They're maybe not even going to bother putting in for the tender. The fact that we put all our shares in for tender, that means we can get out of 40% rather than the 20%. The hollow dot here is where in December last year, they announced that HSBC, the manager, had decided to terminate the fund and return investors' money back to them. We got our money back we got part of our money back in March this year. The rest of the money is coming back in August later this year once they repatriated the capital. Now, none of that means much if the fund underperforms as well. In fact, this fund has also delivered outperformance over the long term as well. You can see here on the bottom left a chart of the performance versus the MSCI China Index and China A shares. The fund's performance is in the blue. Over the long term, it had significant outperformance of both those indices. So we had two sources of alpha there, really. We had their outperformance plus the discount capture. If you combine both of those, our IRR over the course of this investment was 17.5%, which was well ahead of what we would have made had we been invested in those underlying markets. So it kind of goes to exactly what these trading opportunities are trying to achieve, which is to sort of bolt on some alpha from discount capture on top of an underlying market return.
Yeah, brilliant. Well done, Mark. I think that's good. Yeah, we might move over to Q&A for everybody because our shareholders are always brilliant with Q&A. But I might start off with a question that came in ahead of time from Michael. He asked us, how do we plan to balance the payout ratio of our income and our dividend with the share price growth? And I was going to answer that, but I thought, Miles, why don't you give that a go?
Well, I mean, it's tremendously easy. We're going to increase the dividend and increase the payout, and we're just going to generate ludicrously high returns. I mean, the challenge we have, so we generate the returns we do, and we work really hard with, to do that. Then in terms of how we distribute the returns, it's really a board decision, but they can only work within the confines of what we've generated. So if we make a 10% return, there's 10% to play with. Over the life of the fund, we've generated an 11% net return. I think we've paid out 80 to 90%.
90 cents on the dollar.
And I think in more, so I guess the problem that you have two parts of the register, some that want dividend at all costs and others that would like to see the share price growing a little bit and some capital growth.
Yeah.
I think the board's trying to straddle those two kind of competing tensions as best they can. More recently, I think we've let the capital growth tick ahead. So the NTA has been increasing without increasing the dividend. We tried to balance that tension last year with paying the 1 cent special, but I think, my own personal view, as I guess as one of the directors, is the dividend has been very high for a long period of time. I don't feel a need to really ramp it up too much higher than where it is now, but it's also all of your company. So if anyone has a view or an opinion, please let me know, and I will make sure the board knows. And all of that is a caveat to saying I don't think there's a perfect answer to keep everyone in the church perfectly happy.
This chart here, just for everyone's benefit, this chart shows if you had reinvested everything, so maybe a grandchild or a child, you reinvested everything, your 10,000 would now be worth, well, it would have tripled in the last 11 years. The second one is we do have more and more investors doing half and half. They take half the dividend, they reinvest the other half. That gives you that scenario. And that last scenario there, as Miles said, we listed at $1. It's worth $1.35 today, and we've paid 90 cents out on the dollar. Does that answer your question, Mike?
Yeah, it's always a balance.
I know, right?
Would you like to see the capital growth a bit higher? Is that?
Well, I'm really pleased to see that the share price was sort of
stuck
to $1.10
for a long time.
Yes.
Yeah.
I think people probably are just more relaxed about the general investment.
Yeah, with it going up, trending upward.
Yeah.
It's that baby, the third baby. I blame him.
Okay.
The balance is about right for me anyway.
Okay.
Okay, that's great, Mike. Thank you. Please don't be shy. Come on. Usually we have great questions.
Yeah.
With the increase in private capital and private debt, is that making it more difficult to provide a fully franked dividend as compared to a publicly listed organisation?
Well, for us, no. So where we generate most of our returns is buying these assets cheaply and unlocking the value from them. So for us, it's really, we're generating capital returns. We're an Australian listed company, so we pay tax in Australia. Paying tax generates franking credits. That's how we do it. So it's not that we pay a high dividend because we're streaming high levels of income in. I think for other people in the market, possibly the case, as particularly as a lot of these are offshore opportunities. But yeah, it is. I mean, it's a big change that's going on, and one that I don't think people really focus on as much as perhaps they should.
I asked a similar question of Jeff Wilson as part of his WMX one, as far as how does he, with I think it's 40% corporate debt as part of his new fund.
Yes.
How does he manage to still target a fully franked dividend when almost half of it is actually debt rather than?
Yeah. Did
What
he have
was
a good
his
What was
answer?
his answer? Yeah, I'm curious.
I'm interested.
I don't think he got to it because that was about 3.5 hours into the webcast.
Okay.
Oh, okay, ran out of steam.
I'm not sure if he actually got to it.
Well, I mean, to the extent that they generate returns on the bonds and pay tax, that would be a source of franking, I think.
Yeah.
Yeah.
Phil, you had a question?
Yes, well, first of all, congratulations on the GVF performance.
Thanks.
Thank you for the GVF performance. I was interested when you said talking about the discount capture, and you said there were about 100 companies in Australia. I was wondering what you based that on.
So I looked at there's an organisation called Listed, and it lists all of the listed investment companies and the listed investment trusts, and there's about 100 of those. I can point you to the website if that's helpful. But yeah, there's quite a few. There's the AFIC, the Argos. Those are the big ones that you would know. The Mirabookers. These are all listed investment companies that can trade at a discount and are trading at a discount.
G'day. Sorry.
Hi, I'm Steve.
G'day, Steve.
First of all, congratulations, thanks, love the
Thank
fun. Just a cheeky question. If you did start another fund, well as GVF, what would it be?
Well, we have started another fund about 3 or 4 years
We're
ago
not
now.
doing another fund.
We're not
I can't do
doing
it. I can't do it. I
But,
genuinely.
I mean, and really the only difference with the other fund is it's for kind of institutional type investors and it has a more risk-seeking mandate.
Yeah, we've
So
got
it's
a
little bit-
second and last fund called Staude Value Fund. It's almost identical to GVF except it's in US dollars. It has a 2 million minimum. It's in the Caymans and it has a 2-year lockup. So it's very.
But philosophically, he's asking me what we'd like to do. I mean, I love running GVF. We geek out on sharp ratios and managing risk and all that kind of stuff. But the other fund does run with a little bit more high octane, not crazy, but it's seeking higher returns with, can accept down years and can accept higher volatility. Yeah.
What about us? Can we ask a question of the audience? Could you please put your hand up if you would prefer monthly income as opposed to semi-annual income? One person, great. Okay, I don't have to change that then.
Or quarterly, would that move the dial for anyone? Is that really?
Okay,
No?
great.
Okay.
Than's guys, thanks.
Okay, that's good. That makes life easy.
Keep
Sorry.
it interesting.
Democracy is a horrible thing.
A year ago, you were sort of trading at a discount to NTA,
Yep.
now at or above NTA. The fact that you're not raising additional capital, does that kind of say, is that a view on your opportunity set out there at the moment? Like if you were to raise,
Oh, no. Yeah.
No.
is there lots of excitement out there for you?
Nix.
The,
I'll take it. Oh, no, I was
No,
it.
well, we'll dance. I mean, just to say, from the very beginning, so we started off as a very small fund, $50 million, and we said from the beginning, we never want GVF to be much more than 300. So we've grown along the way through capital raisings, always at parity or above, and we've paid out most of our income through the way. So we've really grown from 500 to 220 through raising money. We're certainly not raising money through any view on the market. The opportunity set is where we'd always want it to be. We were frustrated that we're a little bit of a discount last year. We've worked very hard to get rid of that. But
there are funds overseas in the US and the UK that run billions in this strategy. They just don't have the alpha returns that we have. And so we've said from the beginning, we don't want to run more than 300 in GVF. And that's actually a tiny amount on a 600 billion US dollar area that we cover. So it's definitely not an opportunity set thing. And you're right, we haven't raised money since December 2020, so it's been a while. I think, from a board perspective, listening to what the board says, and obviously it's a board decision, my gut feel, or at least my feeling, was that trading at a premium for a little while was a bit tasteful. I think, let's do that for a little while,
we have had a lot of people ask the
But
question.
yes, we understand that might be attractive to people. Yes, please, go ahead.
Hi.
I'm a very small investor and I have shares in Australian companies mainly.
Yep.
But what you were talking about was the growth in unlisted companies, private companies. How am I supposed to access that sector?
Well, we hope through GVF you're
Well,
accessing
I have
some.
got GVF,
Yeah.
but
Elsewhere.
elsewhere.
I mean, it's hard, and it's sort of big picture. One of the frustrations I have, and I think passive investing has been a wonderful development, but there's a counter side to that. So I think the rise of passive has forced a lot of these interesting opportunities out of the public arena, and one of the problems that governments have to straddle is that they need to do regulation, they need to put laws and restrictions around people, and they've done that in spades in the public market, but it's just made the public market a lot less exciting. So you take away opportunities while you protect investors on one hand, you remove opportunities on the other hand. There are opportunities in Australia. So the Wilson franchise run a private fund that's quite interesting. I actually used to serve on the board of WAM Alternative Assets.
Yeah.
Has some interesting agricultural assets and other private equity investments.
There's a private equity. Yeah,
There's
there's a couple of private equity licks in that universe of 100 companies.
There's a Pengana one that I'm not saying they're good or bad companies. I'm just saying that they're out there. And then I guess the alternative is you go into one of these funds directly, but then you are locking yourself up for 5-10 years, and you generally have to you have to put in a lot of money up front. So unfortunately, there isn't really an easy fix. Unfortunately,
I have another
please,
question.
yeah.
What you were saying about America and Trump,
Yeah.
you know, what's going to happen. Are we better off now investing in Australian and European companies and not investing in America?
Yeah. That, I wish I could answer that, and we'd all be, well, GVF would be through the moon if I could care to answer that. I guess the thing with the macro, it's very easy to get caught up in it. It's always very exciting, and it seems dramatic and important as you're focusing on it. But the balancing factor is really, markets price a lot of this stuff in. So everything that I've said to you about now is not new news. People that are pricing US shares are not selling them thinking, oh gosh, I didn't realise Trump was messing up the world. People buying European shares are not going, gosh, you know, there's trade wars not happening. So a lot of what we're talking about is already in the price. I think especially for say a retail investor, I wouldn't advocate you try and focus on those kind of things. I'd focus on longer term investing, trying to find opportunities that suit what you're aiming for, and not getting too caught up in what's going on.
And that is not advice.
And that is not advice. But I guess I would say, unfortunately, there isn't a lot of opportunities here in Australia. I love Australia, I'm Australian, but it's a small market. The capital markets here are not very deep. So most of the kind of new and exciting opportunities are in America and in Europe and other places around the world. Yeah. Hope that helps.
Yes.
G'day. Hi.
Jeff, I'm an original investor in GVF.
Tremendous, thank you.
Oh, thank you.
Are there any intentions of a share purchase plan or a rights issue?
Oh, straight in there.
Well, I mean, would you
Love
like?
it. I love it.
Would you like one? I guess is the question back. I mean, we work for everyone here, not the other way around. So, I mean, we're not in a rush to raise money, but we've said we think it would help everyone if we did from time to time.
Yeah, well, I'd be interested if there was such
Yeah.
a thing.
Okay.
I don't know whether it's the intention of the board to consider anything like that.
Well, we'll take it to the board for sure.
Yeah.
Thank you. Thank you for that feedback. And just to be clear, anything that we do offer, we will offer to our existing shareholders first.
Yeah.
Yeah. We've always done that. and
We've
we
always
would
done that, and we
yeah.
always will.
Yeah.
The problem with share purchase plans is that if you don't participate, well then your shareholding is diluted. And for a lot of retired people who don't want to keep investing, that's a
Well,
disadvantage.
that's a
Yeah.
great point. And I'd like to say where there are exceptions to the rule with that. So if you do a rights issue or a purchase plan and you're doing it below asset backing, then you're absolutely right. You're diluting the value of the assets for everyone.
We would not do that.
We've never done that. We would not do that. So if we were to do one, and this is all kind of, we're just talking about it aloud, it would always be at the asset backing or above, in which case you're not penalised at all. We're
No.
very acutely aware of that problem.
Yeah.
I mean, but you also need to make sure that any issue is renounceable.
If it was a rights issue,
Non-renounceable.
yes.
Yes.
Because essentially that is taking value, particularly if you do the discount. I mean, the trading window
Yeah.
is such that you may well end up with a premium. You know, you can make it and you can decide what you do to try and balance that out. But you know, non-renounceables are no-nos.
Yeah.
Well,
Agreed.
again, but only if you're at a discount. So I mean, an SPP is not a rights issue. So if it was a rights issue,
no,
I would
that's-
agree.
yeah, no.
An SPP is a special thing under the Corps Act, which isn't actually renounceable. You can't make them renounceable. But again, we've never done them at big discounts. We wouldn't do them below NTA. But all of these questions point to why it's very hard to raise money into. If you're I don't want to sound like I'm slagging off the competition, but if you're being honourable and honest to your shareholders, you want everyone to have a fair go. It's actually very hard to raise money into these vehicles. You've got to have lots of planets aligning at the right exact time. Yeah.
Yes, please.
You pointed out the challenges of the changing passive market in the private market. And you're addressing that, I guess, by being aware of it and acting accordingly. But my question really is about the future. Do you have a focus on changing anything in the way GVF operates, or do we see you going ahead in a similar way which may increase dividends, may increase income.
So we're not going.
Where do you see the future?
Where do you see the future? So we're not going to change what we do at all. We've got a formula we stick to. We've always said we'd pay most of our returns out as yield. That's not going to change. What we wanted to highlight the big themes just so that people are aware of what's going on. And then as a little plug to our own fund, just to say we've actually been investing in these. We've been investing in this for 10 years. We're not suddenly waking up going, gosh, we're missing out on all these opportunities. Private debt and private equity has been 20 to 30% of our portfolio since day one. I suspect it will always be that kind of range. We're not suddenly going to say, right, we want to put 70% of the portfolio into private equity. We're not going to change in that kind of radical way. We just wanted, I guess, people to be aware and to understand what's happening and what's changing out there. And maybe to have another perspective on passive investing, which I think at times just has cheerleaders only out in the industry. And passive investing has been a wonderful development, but there are other shades to it.
Shadows, yeah.
Shadows to it that I think people need to understand. G'day.
I've sort of got two questions. One is about this private equity. Are the Australian industry super funds investing in it? And then the second question is, in my day, I was taught that venture capital is very expensive. It's like a 30% return because of the risk. So it seems odd to me that you're saying the new companies are going to the venture capitalists for money when the share market investors want a much lower return.
Yeah.
It seems odd to my upbringing.
Yeah, sure. So, well, to hit the first one, absolutely. So the industry funds here in Australia, I think that's what you're talking about, have huge allocations to private equity, and they invest directly. So they're investing in proper private equity funds where they put their money up. They won't get it back for 5 to 10 years. They've enjoyed tremendous returns. And, you know, as an outsider looking in, I think that's the right allocation. You, as a big fund like that, you probably should have some allocation to private equity. Just to say, though, I mean, one of the criticisms of the industry fund model is that as your membership starts, you know, we've been through a period of growth where industry funds have grown a lot of assets and had a lot of younger members coming through. Looking out the next 20 or 30 years, sadly, you're going to have less and less members and people drawing down. And I think one of the criticisms of the industry funds' big allocation to private equity is how do you match your liquidity with the needs coming up in the future. And another issue that you see come up a lot is how they mark those portfolios. So if you're investing in something that you're not going to exit for 10 years, what value do you ascribe to it along the way? And if you have a member that comes out and wants to take their superannuation out, you've got to let them out at a price. So that's one.
Particularly if you've got a $3 million limit.
Exactly.
Suddenly you've got to value something that's very hard to value.
And someone's just, right, exactly. So I think that's a legitimate kind of, legitimate point of concern. And then to your fund, I mean, I think it just shows, what you're saying, back in the day they're expecting 30% return.
The 1980s and
Yeah.
venture capital, 30-35% return.
Yeah.
You only go there almost as a last resort.
Yeah, so it's flipped in a lot in certain industries, and certainly in the US, it's totally flipped, where it's basically the first port of call, and it's such a large and sophisticated market now that you can really target whatever you want. So if you've got a really high risk, high reward kind of business idea, there'll be guys that want 30 or 40. If you've got a widget that you want to make that's going to generate teens return, there's venture capitals that bank that, and there's multiple rounds of venture capital financing and multiple different types of financiers. And you know, increasingly, this stuff's just not coming to public markets. Yeah, it's changed a lot.
Does anyone have a question for Mark?
Sorry, yeah, I'm still. Why don't you swap
go,
sides?
please.
The euro and the UK look more energised than they have for a while. I mean, how's it sort of playing out?
So they look more
energised.
Right, okay,
It feels like,
But it wasn't hard because everybody was so down on the UK.
been a disaster.
About a year ago, everybody was going to move their listings from the UK to America. Everybody hated Europe. So, I mean, I think it couldn't have got any worse, really, for the UK. Everybody was putting out of the UK. But, sorry.
So capital seems to be flowing in.
Yeah.
About the UK as a value market now, etc.
Yeah.
How are you seeing it on the ground? What opportunity, where are the opportunities?
Yeah, no, I mean, that's definitely been the case. I mean, we speak to all the sort of local brokers in the UK. They're all doing fantastic business. There's just been tons of secondary flow coming back into the European and UK markets. So, yeah, I mean, we're seeing that. Yeah, we see that in M&A as well. So any companies that do sort of lag. So one of the examples we had as well is a property a fund that got taken, well, the portfolio got sold, but there's been a huge amount of M&A in the investment company space, in real estate companies in the UK. So yeah, no, we're certainly seeing that. A lot of money coming into the UK. Quite a few of the, I mean, I think the case study that we probably talked about last year was a song royalty fund. there were two song royalty funds, and both of those got taken out by private equity, again taking advantage of the UK discount that existed. So yeah, I mean it was there, people are noticing it, people have come in and taken them out, but we're certainly seeing a total change in sentiment towards the UK and Europe, partly because it couldn't have got any worse, but also because Trump's, you know, I suppose pushing people a little bit away from the US, really. You only need a little bit to come from the US to go into UK and Europe, and it makes a big difference.
Fair change.
Yeah.
How does that affect the sort of exits you might be looking to make then? Is that in you know, the next couple of years?
I mean, M&A is one of the sort of scenarios we have for some of the investments we made. So again, going back to that song royalty fund last year, or the two song royalty funds, M&A was a big part of the thesis there. The other part of the thesis was one of the features of UK funds, I don't know if you're familiar with them, but typically when they list, within their prospectus, they say after 5 years, we're going to have a continuation vote. So we're going to go back to investors and say, is the opportunity set still there, and should we carry on in this form? And those aren't a formality. That's a good opportunity to sort of reassess the whole vehicle. So one of the scenarios we have when we make those investments on a really, really big discount to NTA is, could this get taken private? So we look at some of the transactions in the private space. The second one is that they've got this continuation vote, and you've got a shareholder base that's really, really unhappy. We know those shareholders, we know what they want. So that's the fallback option. So yeah, I mean, it's certainly a big part of it. In the case of, again, this property fund we could have talked about, it was called Abrdn Property Income Trust. That was a very, very simple real estate investment trust listed in London. That had gone through a process of M&A, which shareholders voted down in favour of just selling the assets one by one. So we didn't invest to use M&A as our exit, but the fact that this M&A activity had happened provided us with an exit opportunity in that particular case. So no, I mean it's good to see, because ultimately you see transactions happening in the private market, and there's only sort of so long that the public markets can trade on that massive discount if you've got the right corporate governance in place and the right shareholder base in place before people have to ask the question, is this in the right form, really?
Oh, yay, yes.
Remind me, this is a trivial question, Mark.
No.
What do you make of Land Lease and the Crown Estates doing some kind of joint venture, which I've read about?
Oh,
so
wow.
can you provide a little bit more information?
Yeah.
Lend Lease.
I read that Land Lease has done some joint venture with Crown Estates, the royal family, to develop properties.
I don't know enough
We
about it. I
don't
don't know enough
know.
about it. I don't think to comment.
Although we do know the guy who founded Lend Lease. He lives in Avalon, doesn't he?
I don't think so.
Yeah, Dave,
you and Dave. Mates.
Whatever. No, I don't know. Sorry, I actually don't know anything about those.
The UK market's a bit funny. I mean, so the Crown owning large amounts of land, and a lot of those kind of old dukes and governors.
No, he's talking about Crown here.
Oh, Crown
and
Estates.
Lend
You said
Lease.
Crown Estates, right?
Crown Estates, and the royal, like the Crown Estate. Yeah.
Oh.
Yeah. So the UK, I mean, we're doing a lot in real estate at the moment. There's some very cheap assets out there. We've made a few investments. We haven't invested in the Crown Estates, but it's a funny
Try
market.
and wind that up.
Yeah, exactly. I think that's sedition, isn't it?
Yeah, that's terrible.
But the Crown Estates, and I was saying, you have lots of sort of old families that own large chunks of London. It makes it a funny market. But yes, sorry, we don't know much about that one.
I know most of your acquisitions are probably over a long period of time, but when Trump announced his today's a great day to make money Truth Social discussion, does that give you an opportunity to get in really quickly to do those sorts of things, or is that something you're not interested in and you're only talking about?
I think we're not really in the, unfortunately we're not in the little kind of Trump investment club where we got a heads up on that, or the crypto. We could have bought some Trump coin. Yeah, no, I think, like we saw that day. I think around that whole kind of episode, the key focus was risk management, and we certainly weren't. It's so volatile, so unpredictable. I think later that day, markets had rebounded. We're up 9% that day. I mean,
hence my question.
Yeah. I mean, I don't think it's the kind of thing we would change our positions, because you just don't know, do you? I mean, in hindsight, it was a fantastic, it was a fantastic opportunity. I wish you'd maybe give us a heads up again.
I was too busy speaking my broker.
Buying some Trump coin as well. Yeah.
Hi.
Just want to get your quick thoughts on private credit. Somebody's been a lot of growth in that.
Yeah.
The return sustainable.
Do you mind if I take that one?
Yeah.
So on private credit. So what's interesting with private credit, I think, which is it's become sort of theme du jour down here in Australia. So loads of funds coming out. I see people talking about it all the time, and it's almost as though like Australia suddenly just discovered it and has gotten all excited about it. So private credit as an asset class has been around for 10, 20 years. We've been investing it for a very long period of time, and certainly offshore, you don't see the excitement that you do here now. I think it's more of a new thing. I can't give you like what's going to happen thing, but I can give you both sides of the argument. So I think one side of the argument, the bullish argument, and it's a fair, strong argument, which is post-GFC, the way banks are run these days, they want less and less kind of traditional lending risk. Australian banks really just want to lend to households on mortgages. It's a fantastic business, low risk, they can leverage it up. They're not taking on a lot of kind of existential risk. So that's kind of meant that a lot of lending that used to happen isn't happening by the banks anymore. And you've also had this big growth of private equity, private credit have come into that space and have come up with some very sophisticated solutions. So I think there's a natural kind of reason why private credit's grown. There's a business case for it. They're replacing bank capital that's retrenching, and they're also being innovative, which they do quite well, and coming up with new solutions to sort of financial problems. So that's why private credit is growing and why it probably will continue to grow. The flip side to that, of course, is Warren Buffett's statement, you don't see who's naked till the tide goes out. There's a lot of money chasing into it now. We've certainly been through a few car crashes, and we've watched and not invested in, but watched from afar and come close to investing in. As in we dodged the car crashes. But there's been a lot of people that have gone into it that don't really have the skill set, that are trying too hard to put money to work at a time when everyone's trying to put money to work. And that's not a particularly good equation, particularly with like untested strategies or untested managers. So it is a little bit buyer beware, but I don't think it's some big Ponzi scheme. There's a legitimate reason why this is happening, and there are definitely good operators having it with a great business model. Would be my 2 cents.
The only thing I'd add to that, a couple of points. I think there's a big dispersion between good managers and bad managers in that space. I think you've had some of the sort of the big names come here and list vehicles. In some of the UK names, we've had some poorer vehicles, poorer managers in that space. The other thing is that these portfolios can tend to be very concentrated because you are, you're writing. These are private contracts with companies that are borrowing from you. So you can tend to have maybe sort of 10 to 20 names in the portfolio. Given that when you're lending to a company, you've got limited upside and 100% downside. I think diversification is never more important than when you're lending, and so those are the sort of two things I'd say. I think there have been a lot of blow-ups we've seen where you've had an inexperienced manager that's sort of just jumping onto the next sort of bandwagon and running too concentrated a portfolio with those loans.
Another one from Mark. Mark, your kind of perspective from Great Britain and across the Channel. There seems to be a kind of increasing sense of common purpose between UK and quite a bit of Europe. That's just kind of my sense of it.
Yeah.
It may not be the case, but if so, what impact do you think that'll have on the economy in that part of the world and possibly investment opportunities?
Well, I think we're already seeing it. Perhaps you heard that the UK and Europe have just. I think like any improvement in that relationship between the EU and UK is going to be good for UK investors. I mean, personally, I sort of understand why people voted for Brexit, but I also didn't. I voted to remain. So I think economically that's been a disaster for the UK. So I think any sort of any improvement in that relationship between the UK and Europe is good. It's fantastic. And it's great for us travelling abroad because we have to join these huge queues at the moment when you go on holiday. And, so much nicer. You see all these Irish people in this, fast tracking through. So, I think, that definitely it seems to be improving. I think the whole Ukraine situation has brought everybody together.
That's what I was going to say. The UK has got a big defence industry. It's one of the big security countries in Europe, and that common purpose, I think, is really...
Yeah, Trump has caused that a little bit, hasn't he, with the forced spending, defence spending.
Yeah, it's like when I tell off one of my kids and they both shout at me, they both turn against me. It's sort of like, Trump sort of told people off and they've all kind of turned on him, so I think... Sorry.
I was just going to say, do you think that the possible investment opportunities are kind of obvious now, or they come a little bit further down the track, that this sort of increased sense of
investment
trade,
opportunities?
I think the thing in terms of what's been announced, it's as Mark was saying, you're coming off a very low base, so it probably helps GDP growth in both countries by a minuscule amount. But I think the more optimistic thing is that at least both sides are talking now, and I think the big win that came out of it is really not so much was announced today, but was the announcement they're going to do this every year going forward, and they're going to keep talking. So sadly, I don't think it's like a.
Are there increased opportunities for us?
Well, I think to the extent we're taking advantage of the outlook being so bleak for the UK and these huge discounts persisting, and there's an improvement in the fundamentals, that has to be helpful to us, because it just means you've got more likelihood of some outside investor who is thinking smartly about the whole thing coming in and seeing a rationale and taking it out. So it should do, provided those discounts are still there.
Gaps that you look for.
Yeah.
Particularly in those that are invested.
Yeah.
Yes, one of the case studies you've talked about in the past was the aircraft leasing company.
Yes.
Are you still invested in that, or is there any update?
Yeah, so we're still invested in that one. I mean, just for background, we've talked about it in quite a few times actually, but back in 2020 we invested in this aircraft leasing fund. At that time it was trading below its cash on the balance sheet, so it sold 2 aircraft, probably the best time aircraft sale ever, in February 2020, just before the pandemic. So it sat had £130 million of cash on its balance sheet and a market cap less than that. So we bought in and we were getting the aircraft and 12-year leases for free there. It paid out a big chunk of that cash later that year, and it's performed fantastically actually. It's been a real winner. I don't know exactly what the return is so far on that, but it's made several capital distributions since then of this surplus cash. I mean, it started off holding back a huge amount of cash, and over time it's become more comfortable. It continues to pay this very high yield, like a kind of a teens yield, and it's still accumulating cash even after paying that, which it then pays out in lumps every now and again. The outlook for the A380 is the sort of controversial aircraft that fund owns, and as you probably know, it's a fantastic experience flying on an A380, but the only real airline that's adopted it and took half of them was Emirates, who thankfully is our, who we have our leases with. There have been several funds in the UK that were launched to own A380s and lease them to Emirates, and at the end of those leases, Emirates has bought all of them so far. So we're getting a better sense now. So previously, when we made this first investment, we were just investing because we were getting it cash. We were buying all this stuff for free. Over time, we relied on the contractual payments that Emirates would have to pay at the end of those leases. Over time, we're getting a better sense of what those A380s should be worth if we're being conservative. And we've got loads of data points now. So we still hold it. And it's done very well, and it still looks attractive to hold.
It's done tremendously. I think we've trimmed it.
We trimmed it back a bit. I mean, even though they've been making these huge distributions, the shares have done so well that we trimmed it back from a sort of risk management perspective. And obviously, as this thing gets more expensive, there's a certain element of the price rise that's justified by the fundamentals. A certain amount of it is, it's lowering your future return. So we have trimmed that back in line with the prospective return there. But
we still hold it. I mean, one maybe we won't talk about too much today, but one we might talk about over the next few years, and I'm just going to throw you a hospital pass, is we own a bunch of airlines we bought during COVID. At the moment, we're in the middle of a trade war, and we're out there buying container ships at 70 cents on the dollar. I don't know if you want to say.
Well, not container, actually, bulkers. So we actually own, there's a fund in the UK, trades on a very deep discount called Tufton. They changed their name. It was Tufton Assets, I think it's called now, but it owns product tankers and bulkers. Trades on a big discount, as I say. Good management team. They did a really great job, and actually they did used to own containers, and they sold them pretty much at the peak recently. Post-COVID, when you had this huge demand for containers, they managed to sell theirs, flip theirs out into that, and move it into something else. What's really interesting about that fund is that it's got a realisation period from 2028 onwards. So they've turned around and said, we're going to give you your money back. We think the opportunity set runs till 2028. From 2028 onwards, we're going to be in the process of selling these ships down and returning your money to you. So you've got the return from a portfolio of ships that they've leased, run by a smart manager, and then you've got this huge discount that you're taking out over that period as well. So
thematically, it's not that different to buy, and we're not buying them as cheap as we bought the aeroplanes, but it just sort of is interesting to say we're now buying container ships because we're in the middle of a trade war and we're buying cargo ships cheaply.
You've alluded to the geographic allocation of the portfolio. Can you say a bit more about that and how you see that trending?
Shall I do it? Yes. So our primary investors, we're investing into listed funds all around the world. So we might invest into a listed fund in London or a listed fund in Singapore, but its underlying assets will often not be in Singapore. So just to say, so the vast majority of opportunities in the world are in the US. It's the biggest capital market. It's the most dynamic capital market. So around half of our assets are normally US dollar related in some way, either equities or credit. Then there's another big chunk of opportunities in Europe and Asia, so it's sort of been 20% each over time. And that hasn't really changed through time. It's just a function of the opportunity set. We might access them through a Canadian fund going into Europe or a Mexican fund going back into the UK. But in terms of the underlying assets that we own, it is very diversified. It looks a lot like kind of the broad cross-section of the global economy. And we deliberately target that to manage risk and keep it a bit dull, but also lower risk. Yeah.
My question was more the same.
Oh, cool.
The question underlying geographic assets.
Okay, cool. Cool. Yeah, two, yep.
Is there any recent GVF investments that you can talk about and why you purchased them?
There's a couple, but normally when we come out, we'll do a case study that's just finished and a case study that we're in right now. We do that so that you can come there and hold us to account in 6 to 12 months' time. There's a couple we're building right now that we're really excited about, but we're also very conscious that our competitors are watching the videos and reading the stuff that we put out. So unfortunately, we chose this time not to do that. There's one we have talked about publicly, which we've been in a long time here in Australia. This is all obviously buyer beware, but we are a large shareholder. We've talked about it in URF. So it's a property fund listed in Australia. It used to be the old Evans Dixon's property fund. It has a very checkered history. Because of that checkered history, it blew out to an enormous discount. We were the largest shareholder, and now we're sort of equal largest shareholder. Mark has done a sterling job behind the scenes there in knocking that into shape. A few of the grey hairs, URF related. But now it's a nice clean story. It's still on a large discount, it'd be a discount about 30%. They're in an interesting portfolio of New York and New Jersey properties, residential properties, and they're in runoff. There's no fighting or argument to do. They're selling the assets, they're giving the money back to shareholders in Australia. If they can sell the assets in line with book value, and they've done
a huge amount of that. Yeah, they're selling generally about $20 million worth of assets every month, pretty much bang in line with where they've got them valued. The only thing you've got to account for is you have to pay sort of extortionate cost to sell things in the US. It's something like 6 or 7% sales cost, but you can bake that into what you expect to come back.
Yeah. So we see this really interesting discount. The discount's going to come out as they sell the properties, and you're exposed to US property prices along the way.
They've got a ton of cash. Actually, one of the interesting things about that, we talked about it in October in some of our slides. They've been accumulating cash, and we had hoped that a huge chunk of that would come back early this year. Unfortunately, they've got a covenant. They had a covenant on their debt, so they could only reduce the size of the company below a certain amount, which prevented them paying a bigger distribution. However, they've now renegotiated that, so they should be in a position to start making meaningful distributions now.
So a follow-up question on that. Yeah. Jeff Wilson is obviously a board member of GVF and held URF in war and has publicly said that they've sold it because the remaining properties, they were concerned that the values weren't going to continue hitting book value, etc. Like, what's your view on that, since he's publicly sold and suggested that's why they've got out, they've got their valuation hit.
So I think, a couple of things. One, we were in URF a lot earlier, so our entry price is a lot lower. And then I guess the other thing, the valuations has been kind of the bugbear since the beginning. So when we first started looking at that, we had a lot more concern about, are these properties worth it? We've done a load of work on how they value the properties. We think it's a really robust kind of formula. And they sold $200 million of properties at book value or thereabouts initially when we first were involved to help pay down debt. They're now re-engaged the selling program.
I can't remember, but it must be over $500 million worth of assets they've sold now.
We're less worried about that. The manager selling them is properly incentivised. The manager selling them for us in New York doesn't make any money unless they sell them at or above book value, and they've done a really good job so far. And we do a lot of our own research on what property prices are like. In part, possibly, I didn't know that about Jeff. But
I didn't even know it was on the register.
I didn't know it was on the register. I didn't know he's come off the register, just to show you how independent we actually are.
Yeah.
But a part of that too is probably possibly a view on interest rates and things like that. So what are US property prices going to do? But we're much more positive on that. And I guess the thing, a big part of what we do as value investors is that idea of a margin of safety. So there's still our property price is going to fall so much that it wipes out a 30% discount. We're generally more relaxed. Yeah. I hadn't known he sold, that's good to know.
Just one final one for me. When you think about discount capture, which is a fair part of what you do you have any sort of guardrails on if you buy something at a 20 or 30% discount, do you then get out of it when it's 10 or 15, or is it
absolutely
vary by industry and by?
Yeah, no, absolutely. So everything we go into, we're thinking about how much discount capture can we add on top of the underlying asset class, how much return are we going to have, excess return for owning equities or owning bonds or owning cargo ships. And if the discount comes in a long way, obviously the prospective return comes down a lot. So every month we have a meeting between all of us on every single position. Are the prospective returns still good enough to justify the risk that we're carrying? And that is a feature of our strategy. Sometimes we are a bit lucky. We buy something cheap, we have a plan in place, but we don't ever get a chance to implement the plan. The market just takes it higher, and we are very quick to tip things out.
It's worth just talking about we probably look at discounts a little bit differently to I think a lot of other people that do discount stuff. You'll see a number of sort of competitors of ours quote things like look-through discounts. The way we think about discount capture is per annum. So over what time frame are we expecting it, and is that a fair compensation for the risk that you're taking with that asset? I think that's a sort of slightly different thing. So, something may be a fantastic investment when it's on a 3 discount. Because you're going to take it out in a couple of months versus
something that might be on a 50 discount, but is always going to take you 15 years. It sounds exciting, but it doesn't really do much for you. Yeah. Thank you very much, everyone. I really appreciate your time, and enjoy your lunch. We'll be around to keep chatting.
Thanks.